Centuries of shared gold and silver money came to an abrupt end in the 1870s. New silver discoveries drove down the price of silver and made the existing rate of exchange between the two metals unstable. So governments either had to change the rate or had to choose between gold and silver. Great Britain's status as the global market leader attracted the other countries to use the same monetary system. In the 1870s, most major industrial countries joined the gold standard. When a country's government went on gold, it promised to exchange its currency for gold at a pre-established rate. The country's currency became equivalent to gold, interchangeable at a fixed rate with the money of any other gold standard country. Germany went on gold in 1872, Scandinavia in 1873, the Netherlands in 1875, Belgium, France, and Switzerland in 1878, the United States in 1879, whereas in 1871 only Britain and some of its colonies and its ally Portugal were on gold. By 1879, most of the industrial world had adopted the gold standard. With all major currencies directly convertible into gold at fixed rates, the industrial world essentially shared one international currency. In effect, gold was common global money for all countries on the gold standard, but under different names: marks, francs, pounds, dollars in different countries. Gold-backed money invested by one country in another will be paid back in equivalent amounts of gold-backed money. Contracted prices would not fluctuate, for exchange rates did not move. The gold standard rates of exchange between the pound and the mark, the franc and the dollar, and other currencies were so fixed for so long that it is said school children learned them by rote, because they seemed as stable as the multiplication tables. Rote learning is the memorization of the information based on repetition, e.g., learning the alphabet and numbers. Not everyone welcomed economic integration. With the opening of the world economy and the application of new transportation technologies, cheap new world grain flooded the world market. The dramatic fall in prices devastated many rural areas in the old world and caused near starvation conditions from Scandinavia to Sicily. A macroeconomic phenomenon that has gone down in economic history as the Great Depression of 1873 to 1896 contributed to dissatisfaction with free trade and the gold standard. This, however, was not a real depression, as it wasn't an economic collapse, but a gradual and continual decline in world prices. This depression of prices caused serious problems. Prices and earnings declined, but debt burdens remained constant. Expectations of further price decline caused uncertainty and pessimism. Producers faced with the declining prices sought relief by protection from imports. Farmers and manufacturers demanded and often received protective tariffs that reversed the previous trends towards free trade. France and Italy engaged in bitter trade wars. The world's largest economy, the United States, raised protectionist walls around its domestic markets, and the world's second largest economy, Germany, increased tariffs on many goods. Great Britain and the Low Countries almost alone continued to stand for free trade. For those that thought they were on the losing side of the world economy, the gold standard became a potent symbol of the hated economic Pax Britannica. American opponents of gold insisted a vast conspiracy against mankind has been organized on two continents, and it is rapidly taking possession of the world. According to American and gold orator Mary Elizabeth Lees, gold supporters were stooges of this conspiracy. Wall Street owns the country, money rules, and our vice president is a London banker. As prices fell, particularly steeply in the early 1890s, complaints about the gold standard gathered strength. Farmers and miners believed that going off gold would enable their governments to push prices of their golds higher. As the gold standard trembled, the international financial system began to show signs of strain. The Great Depression hit debtor countries particularly hard, impeding their ability to pay their creditors. Faced with destitution, American farmers organized themselves into the country's first real mass movement. The populist movement and its People's Party elected hundreds of state legislators and dozens of national senators and congressmen in all the country's southern and western agriculture regions. The populist program demanded, first and foremost, that the United States go off the gold standard. Under the gold standard, the party's platform charged that the supply of currency is purposely abridged to fatten usurers, bankrupt enterprise, and enslave industry. The solution to what the populists called the money question was to free the country from this British-led scheme to enrich international bankers, investors, and traders at the expense of farmers and miners. Instead, America should go off gold and on silver at a depreciated exchange rate that would raise farm prices and lower interest rates. In July 1896, as farm prices stayed low, the Democratic National Convention convened in Chicago. All talk was about how the populists and their supporters were turning the 1896 campaign for the presidency into the epoch battle of the standards.